Right, guys, I think we've got it finally working, and I will switch to the main image here. Good morning, guys. Welcome back. Really excited to finally get the live stream going. So this should be a little more interactive, exciting. We can get some like screen share stuff going, and you can kind of visually see what I'm talking about. Although I'll say, kind of historically, like I've always relied primarily on verbal communication for these kinds of shares. So, I think it'll be just as useful for people who are just listening along, as well as those who are watching through. And of course, you can always go back and watch the recording. We'll always try to publish the recording later for your reference, and we'll drop that in the Discord. So welcome, good morning, happy 4th for those of you that celebrated. I, for one, thought it was a pretty problematic July 4th with the Monday on full work mode and people trying to kind of like split hairs with some time off. But it was a lot of fun, pretty good weather. But I think there's a lot of churning in the background of the economy and the markets. And so I'm going to jump into that today. We're talking about three things: China, slow motion car crash occurring in credit, something I've been sniffing for a while, and I'll kind of talk a little bit about why I'm concerned. And July 4th temperature check. I'm going to kind of repeat Monday's call because we were just sort of prefacing it, but it was a really interesting round of conversations with a pretty diverse group of people, so I think you guys will enjoy. So let's start with China, something we've touched on before, but we're sort of starting to see it begin to manifest both on the geopolitical front as well as their economic front. So there's a lot of concern about China's own growth. And in fact, it's been this slow burn coming off of COVID. Obviously, China entered the COVID cycle first. They suffered to a greater degree because the policies and whatnot by their government were particularly harsh, locking people in, bringing people to different locations. By comparison, a little bit more challenging over there. It is what it is ultimately. But they came off that cycle. They came onto that cycle before us. They didn't really come off of it sooner. In fact, they had COVID policies in place for longer than the U.S. A lot of people are saying that has stifled domestic growth and domestic economic activity in China, and that has kind of continued to domino effect because first we saw massive real estate problems and the debt behind the real estate, of course, affecting the entire real estate market. China has a lot of empty space that they've really built out and a lot of corporate value that's been created off of building those empty spaces. And then the debt started going bad. That was sort of symptom number one. Then we began to see an overall slowdown in domestic consumption. We got to see different types of debt begin to kind of accrue issues sector by sector. We saw a massive backlash against their tech sector, first starting with Ant Financial, a derivative of Alibaba, trying to become this massive finance company. And their CEO was basically sequestered and questioned, and they basically took on Ant Financial, destroyed it to some respect, and now there's sort of a different boss in town in terms of Chinese technology. And these ideological purges, I'll call them, in the tech sector, and more financial purges just to strengthen the financial system, continued through 2021 into 2022. And so it's difficult to have avoided a situation where China was not in a difficult domestic economy situation. Obviously, still the world's largest exporter of manufactured goods, of inexpensive manufactured goods, but moving up the quality chain as well. But it has not been working out for them. If you look at their monetary policy, they've also deviated, right? So China has been actually cutting interest rates while the rest of the world is raising interest rates to try to combat higher prices and inflation. China is cutting interest rates because they're more concerned with economic growth and trying to keep that flame, that ember sort of, on fire and hot, while they sort of get pummeled from all sides, because China has also lost a great deal of business to ancillaries, to India, to Taiwan always in some respect, but to Vietnam, to India, to other Southeast Asian parts of the world. And there's actually a funny contrarian consensus, right? Forming around some of the macro investors of the world that are switching their bullishness, or they're switching their allocations, taking out of China, pouring into Japan. I think the Japan story is a little more complicated and a little more hopeful, given some their population dynamics, and just the last 20 years for Japan, 30 years for Japan have been enormously difficult to create growth and deal with their sort of economic environment. But China, just putting it on your radar, kind of going through it, if you want to put it in those terms. Next thing, slow motion car crash in credit. This is something I was reading quite a bit about this morning, but it's been sort of at the forefront of concern for the last year at least, right? And I think it really starts from A, inflation, B, interest rates being moved up to fight inflation, and then C, what we're seeing in the economic curves, in the yield curves of the world. So to put it in the simplest terms possible, a short-term loan for 1 month, let's call it a year, a short-term loan for 1 year costs, or is paying out, depends who you are, if you're the lender or the borrower. Let's pretend we're the lender. So a loan that I give someone will make me the same amount of income that year in terms of the interest that I'm going to collect from my borrower as a 20-year loan. It's obviously a 20-year loan, you get paid more cash flows because it's longer, you get paid every year, or you get paid twice a year. But on the short-term loan, you get paid that one time, but it's the same return as far as the yield per year. So you're better off sort of recycling 1-year loans as opposed to lending one person a loan for 20 years. That's at least what the pricing is telling us. It's not necessarily the reality, but it's what the market and the pricing is telling us. To the normal person, I wouldn't even say kind of like the layman or anyone really. Just I think anyone looks at that common sense and thinks to themselves, well, why would I take the risk of giving someone more time to pay me back this amount if it costs the same, and so many things could happen between now and then. When this happens in financial markets, it has almost always been an early warning indicator to a recession. So when you see that short-term debt is costing or yielding the same as long-term debt, that's usually a red flag. For macroeconomic conditions, for local economic conditions, put it that way in the U.S. And so in the United States, we're seeing that, and it's actually been in action for the last year. And so you have kind of macro people, you have economists, you have strategists waving their arms and saying, guys, we're headed towards a recession. This indicator is pretty solid. And you see the story develop. I'll be surprised. I mean, we've really held off. You heard me on Monday. It's been a very interesting year because the economy has held up, growth has held up, stocks have done fantastic despite high inflation and a lot of recession warnings. However, now I think we're starting to finally see some of the unraveling. So first up was, of course, the small regional banks earlier this year. They took a beating. Silicon Valley Bank, a lot of chaos, a lot of worry, but ultimately the banking system was saved and buoyed by the systems in place, the backstops in place by regulators. They had cash to bail out the depositors of these banks, and everything was well. But it was something that only months before I was saying, guys, if interest rates go up past 5%, we're going to see stuff start to break, or bolts start to pop off under the pressure. And I think that was kind of one of those first layers of pressure. Of course, any companies that were like really over leveraged and just not bringing in the revenue to cover their debt payments. This next layer, I think we're going to start to see it now. There's been massive hype in the world of private credit, which is a fancy way of saying private lending, private loans. There are entire funds, hedge funds, or private equity funds that focus on lending private people money at a rate that they themselves determine is fair or makes sense for the two parties. This is attractive because you don't have to trade publicly, you don't have to rely on markets, you don't necessarily have to rely on the Fed funds rate or any sort of benchmark. You just sort of P2P go, hey, you're a shipping company, you make this much per year, we'll analyze your financials, we'll lend you, 50 million at 7%, 8% for the year or something like that, and you have a fund just churning investor money into these loans, in a strategic basis. And so that has been a sort of boom town in the financial world as far as hiring, as far as growth, as far as fundraising. And I start to see a little bit of that red flag, but it'll be interesting to see the returns. But there's a lot of people concerned that if interest rates go up much higher, the gig may be up, the musical chairs music may stop here, and then we can see kind of a rash of bad defaults and investors getting burned in these funds and that type of thing. So this is something we're going to look more into as we go on through the summer. It's certainly a hot area in the market right now. It's worth taking a look. Not sure if it's worth investing in. Not something I have jumped into too heavily as far as like intent wise or proper due diligence, but we'll jump more into it soon because it's definitely a center of attention. And so July 4th temperature check. I have here in my notes who I spoke to. Of course, anonymous. We protect our sources here. But I spoke to a writer, a comedian, a manager, a banker, a couple of senior citizens, as well as industry professionals. And I'll start with the writer. So I went around and asked a couple of questions. One was, prices, right? How have prices affected you? Inflation, what have you noticed? And there's also a little bit of geographic variance here. We've got New York, we've got Florida, we have the Midwest. And first I asked about prices, then I asked about AI as promised on Monday. So I'll start with prices. So the writer seemed fairly agnostic to prices. I will say pretty thrifty individual, pretty sharp individual. So, they had kind of made solid long-term decisions on a financial basis, which I thought was impressive, one, and two, great reason to be relatively agnostic. But, I think it's something that's always very front of mind for this person, and I have to commend them. So relatively agnostic, not feeling too much pain. They've sort of locked in a lot of their fixed expenses. And if anything, they've seen, increases in income to an extent that it hedged that out. Second, comedian, definitely feeling the burn a bit, but has a similar profile to the writer. And so I will say they've done a great job as far as that. I also think there's just a generally positive outlook on prices and all of that domestically from the comedian, which was surprising, especially considering their views on AI. I'll get to that. And then I had kind of a manager, like a corporate senior person, seemed to be very, very concerned about pricing, inflation, tax policy. So ultimately fairly bearish about the entire situation and prices in general, citing, enough to cause, reason to move or make a change or cut expenses or figure out, different new income. So an interesting perspective there. And then senior citizen also, of course, blown away by it. I think it's that exponential effect of just sort of seeing prices increase over the long term and then seeing a sudden spike in the near term. Very, very, very concerned. Senior citizen is also, I think, a factor of, they're not personally generating cash flow through labor. I don't have 100% clarity on this person's full financial situation, but it was probably clear that they generate some sort of passive income through a lifelong of investments and such. But of course, that's always a concern for someone who's retired, has kind of limited passive income, and is looking at prices and looking at expenses. It's a very natural thing. It's also a funny thing when you compare people who inherit versus people who sort of earn all of their wealth. This is not the case at all as far as like inheritance and that sort of thing. But it is. I'm just pointing out that it's a funny psychological profile difference that you see over time working with people. So last but not least, AI, the writer, who I align with, I think in the closest way. Their thoughts were, this is going to take a lot longer than people think. There's someone on FinTwit, there's someone on LinkedIn influencing, there's someone on TikTok social media saying either AI is going to take all your jobs and you're screwed, and then the other extreme is, use these 4 AI tools to get ahead and be 10 times more productive. The future is almost a AI paradise where you can hardly do any work but be unbelievably productive. I fall somewhere in between. I don't really think it's going to take anyone's jobs in the near term, and I don't think that it's going to unlock an enormous amount of productivity, perhaps in the development world, but I think in anything that's like professional service, can be consulting, banking, lawyers, that kind of thing. I think it's going to take a very long time for both clients to trust AI first organizations, and then for these organizations that have the trust of the public to implement these tools correctly. So that's how I feel, and I align with Mr. or Mrs. Writer. Comedian, extremely bearish, hilariously bearish on AI, hates it, doesn't want it, so there's certainly a bias here, but also just doesn't think that it's really capable of replacing, a comedic writer or a talented writer. It's difficult to sort of replicate style with AI as it is today. It's difficult to develop a workflow that makes sense creatively because you're either prompting an AI or you're sort of writing, so it's going to take a little bit of an upskill period for high quality comedy to be completely replaced by AI. I agree with that, but I think they're a little delusional on their sort of, not delusional, but I think they're just a little exaggerated as far as how much they hate it and how unlikely it is to succeed. So I think the comedian represents the other extreme of the temp check for July 4th AI. The banker I spoke to was pretty bearish. Feels similar to myself and the writer. It's going to take some time, especially in finance. This is something we riffed on about for a while, was that finance has been trying to implement AI for a very, very, very long time. I mean, the practice of taking massive data sets in the past of market data and trying to use computer models to predict the future or better model that information to make better decisions going forward. There's also automated, algorithmic trading that you could argue is a form of artificial intelligence. So it's been something that this industry has been working for an extremely long time with very little to show for it. There's really only a couple of firms that I think have really done a good job of translating high-tech injection and innovation in as far as data technology to public markets and private markets investing. Those two firms have been Renaissance Technologies and D.E. Shaw, in my opinion. If you know of any others, I'm super excited to read about them and learn more. But as far as my experience and working with some of these funds, those have been the two that are like, whoa, you guys are nerding out and also succeeding. Other firms that spend an enormous amount on sort of quant data crushing and trying to predict the future tend to spend too much money and not have too much to show for it return wise. So sort of constructive bearish view from Mr. Banker. And I align with a lot of his ideas as well. And then the senior citizen was a really interesting case. She was very worried that everyone's going to lose their jobs overnight and that these things are going to take over. To be fair, if I was, over 80 and someone showed me ChatGPT and asked it to write a short story or summarize some article or something, I too would freak out. So I feel the sentiment. I think it's a little overstated. I will say though that this individual was so bright and eloquent and impressive that I take their opinion seriously, especially given the breadth of their life experience and different technological cycles, economic cycles they've seen. So definitely took that with a grain of salt, despite not being completely aligned with them. So that's it, guys, for today. This was our first little live streaming test. Hopefully it went well. We'll catch up on Friday. Have a good day. Bye, guys.